The following is paid programming.
It's time to talk taxes.
New friends, new opportunities, new partners. EG Tax.
It's Ask the Tax Lady with Esther Gulius and EG Tax on News Radio 930 WBEN. To reach Esther now, call 803-0930. Toll free at 1-800-616-9236. And cell calls are free at star 930. And now, live from the WBEN studios, it's Esther Gulius.
Hey, everybody, this is the Tax Lady, and this is our hour to get you up to speed with the wonderful world of taxes. Let's face it, month and a half, and that's it, and the year is in stone, and we want to make sure that we save you money. So if you have any questions, if you've gotten love letters, if you can't pay your obligation, if you're getting weird things from people that are soliciting to you. I saw something today that somebody's supposed to be sending me $475. I don't think so. But anyway, give us a call, 8030930, 8030930, star 930 in a cell phone. You can text us. We always loved your comments, 716-8030930. And I got Tiffany Fabian and Christopher Fabian in studio with me. Hey, guys.
Hey, happy Saturday.
Happy Saturday to you, and happy Saturday to you, Chris.
Happy Saturday. Hello, Esther.
Hello, Christopher. Okay, so of course, we want to wish everybody a happy Thanksgiving. It's a wonderful thing when you are thankful for something, right?
Absolutely.
So many people take things for granted, and I know myself, I don't. So I'm very thankful for Buffalo, for WBEN, for all of our listenership, all of our clients, because it's just such a blessing to serve everybody.
Oh my gosh, that's what we're here for. I mean,
That's
that's
for
what
sure.
we're here on this earth for, I believe.
Right. So anyway, 8030930, 8030930, star 930 in a cell phone. Text us 716-8030930. And I know we've been talking about year-end tax planning, but I thought we'd give it one more shot here because I want to make sure that you understand that these are things that you should be looking at. If you want to change your tax situation, you have to do it within the confines of the calendar year if you're a calendar year taxpayer. And so that is wrapping up here now, folks. So here's some things that you should be aware of. First of all, the tax brackets increased this year. So explain what that means.
Sure. So they raised the income thresholds on each bracket. So like the 10% for a single person went from $11,000 to like $11,600, and the 22% went from $41,000 to $44,000, and so on. So they are giving you more income to be taxed less
At a lower rate.
Right. So
Not a tremendous lower rate, but there is a little wiggle room based upon the inflation.
Right. And I know with the increase in standard deduction too, I figured it out. A single person who makes about $75,000 saves about $1,100, and a married couple who makes about $150,000 saves about $2,200 a year. But people got to understand, that doesn't mean their refunds are going to get bigger by that, because when they adjust the tax tables, they also adjust the withholding.
Right.
Yeah.
Yep.
I know. I think there was a station that came in and interviewed you during the week, and this was his part of his interview, wasn't it, Chris?
Yep.
Yeah. And what were you going to start to say?
I was going to say people got to really watch their pay stubs, which may mean going on your phones, your iPads, your computers, and actually looking at your pay stub.
At your withholding. But here's the thing, and especially as we're approaching the Christmas season and the gift-giving time of year, maybe you don't want them to take a lot more money out of your paycheck. Maybe you want some more take-home pay, because getting a large refund really is not a good tax planning strategy, is it?
No.
Because you're giving them the money, especially when you're taking a look at 5.5%, 5.75% in CD rates. They're giving you nothing on that money that you're sending to them. You're making yourself poor. You have less to live on. You're tempted to use your credit cards at 25 and 28%. And so it's not a good thing. So, but what Chris is saying is very true. This is the time of year that you should pull out your pay stub and take a look at what they have been withholding. You can call us at EG Tax. We'll be very happy to give you kind of something to shoot at here, whether or not you're going to get a bigger refund, stay the same, or smaller refund, and then maybe you can adjust your withholding accordingly.
Exactly.
Right?
Yep.
Now, because there is more room in each tax bracket, and because the standard deduction increased, that means that here is a good thing that you can do, but it only works if you do it. And I'm not sure people even understand what I'm saying is that if you are somebody that's, let's say, for instance, a senior citizen, and you're filing a joint return, your standard deduction is $30,500. That means you don't pay any taxes until taxable income exceeds that figure. Which means that if you have an IRA, a 401k, that would be taxable when you take it out, you can take it out tax-free by utilizing those standard deductions to your benefit.
Yep.
Right?
That's right. Yeah. So it's there was somebody I was talking to on the phone the other day, and he was talking about his RMD, and I was like, you've got this much room before you even pay tax, so you should do it now.
Right. You don't have to wait till you're 73, especially if you're somebody that has modest Social Security, no other source of income, and you might be able to take $20,000 out of your IRA or 401k plan tax-free. Then stock it aside on in your investment vehicle, and the only thing you'd have to pay taxes on then would be appreciation. And many people could just roll it over to a Roth, right?
Yes. Yep.
And so then you'd never pay taxes. But here's the thing. We can give you all these good suggestions all day long, but if you never do anything about it, then you overpay.
Yep.
And that's the sad part.
Yep.
Yeah, don't like seeing anybody do that.
Want to go to Tracy before the break?
Yeah, let's talk to Tracy. Hi, Tracy. How can we help you?
Yes, I'm an Uber driver, and I've been doing this for a number of years full time. And I've been taking the deduction for mileage, but I actually had a passenger that was an IRS agent, and he told me because my vehicle is my business that I should be depreciating anything having to do with my vehicle.
All right, so you can either take the standard mileage rate, which is inclusive of depreciation, inclusive of repairs, inclusive of interest, and it's a fairly high number and easy to keep track of, or you can depreciate your asset, whichever is better. So that's something where what you should do is give us a jingle on Monday. We'll run the numbers for you so that you can see if it's better for you to depreciate the asset.
Tracy,
He told me that I could do both.
You cannot do both. He could not have been an IRS agent.
He told me to get a CPA to look into it.
Okay, well, if your IRS agent didn't know tax law, then you can do either or.
And also, Esther, if she's already taken the standard mileage rate, she can't switch to actual anymore.
Right,
No,
but that's why I said we want to work out the numbers.
read
But
it in the
but
textbook,
but
you can see
anybody that says that you can take the standard mileage rate and depreciation doesn't know tax law and would just get you in trouble.
Okay. All right.
Okay.
But you
so
could
give
do-
us a call. We'll be very happy to help you. I'm Esther Golias, the tax lady from EG Tax, 8030930, 8030930, star 930 on the cell phone. You can text us at 716-8030930. We're going to take a short break. Be back with your calls, texts, and comments after the break. Hey, family, we want to help you. I'm Esther Golias, the tax lady from EG Tax, joined in studio with Tiffany Fabian, Christopher Fabian, and we're trying to get you kind of tuned up here for tax season to make sure that if you can make a move to save you money, that's what we're all about. right,
yeah,
guys?
Yeah, and circling back to Tracy, so she really, or whoever does her return, should run the numbers and see which way is better, actual or the standard mileage
Well,
rate.
she thinks you can do both.
No, well, you can't, but you should
Well, I
see
know,
which
but
way.
so that's why this guy could, if he was an IRS agent, not for long, because you can't do that.
Well, just like there's some, there's a lot of people that think they know things, but they don't, even though,
Yeah, well, anyway. All right, so another thing we should do is moving on towards the end of the year. If you are able to itemize, that means your expenses that you write off are more than the amount that they allow you based upon your filing status, you should get those things paid up. And even if you can't itemize on the federal, you may be able to itemize on the state. So actually, you might be taking the standard deduction on the federal, but you itemize on the state. Now, some of the things that go into the itemized deductions are state and local taxes, which would be your property taxes, your state withholding, foreign taxes that you might pay, but that's capped at $10,000, right?
That's right.
But only on the federal, not on the state.
Correct.
Correct. In other words,
If your
you could have
property taxes are-
17,000, right, on the state. Your medical expenses that exceed 7.5% of your adjusted gross income. So if your adjusted gross income is $100,000, you need $7,500 or more in order to get a dollar, right? So everything over that 7.5% would be deductible. But this includes a myriad of things, dentures, braces, glasses, health insurance, Medicare Part A, B, C, D, QRS, all of that. Your not for cosmetic surgery, right?
Correct.
But chiropractors, nurses, hospitals, all of that goes into medical. Even if you borrowed the money on those wellness cards, like let's say
Care
that
credit card.
your teeth were going to be $30,000 and you put it on a credit card. As soon as you sign your name to the credit card, it's the dentist was paid, and so therefore it's a medical deduction. So you want to make sure that as we're approaching the end of the year, that if you have something that could be done now versus January, and you think you're going to exceed that 7.5% threshold, do it now.
Right.
Yep.
And also, too, the new homeowners in the last couple of years, they might be able to really look at the itemized deductions because the interest rates are going up.
That's exactly right. I mean, now you take a look at 8% interest rates. When interest rates were 2%, it was very difficult to exceed that standard deduction. But now with 7-8% interest rates, you'd be and the cost of housing, right?
Yep.
And that all goes into your Schedule A itemized deduction. Now, if you do a home equity credit line, I just heard it on the radio the other day that somebody says that you could pay off your credit cards with a home equity credit line and it would be deductible. Is that true?
Not on the federal.
Not at all.
Yeah.
So if you're doing a home equity credit line, it is a really good thing to do if it's going to pay off your credit card debt, but not because it's going to be deductible. Because the only way your home equity credit line will be deductible is if you're using it for improvements or repairs to your personal residence,
Correct.
right?
Yes.
Okay. And then charity. And this is the time of year to give. Clean out your closets, list everything that you're giving away at a fair market value, at a garage sale. And if you are a generous person and you want to give, rather than cash, if you give appreciated assets, you get the fair market value at the date of the donation, even though you didn't pay the capital gains on it. So, if you want it, let's say your church is doing a drive and you promised $10,000 and you got ABC stock and you paid $2,000 for it. If you sold it, you would have maybe an $8,000 gain. But if you give it to the charity, you get the $10,000 deduction and you don't have to pay the taxes on the gain. So that's a smart way to do it.
Yep. Edith has 3 text questions.
Okay.
The first one is, do I still get to count the higher gross income towards my future Social Security when I max out my IRA contribution every year? That's question number one. Do I still get to count the higher gross income towards my
Yeah,
future
because
Social Security?
the what goes into figuring Social Security is not your taxable wages, but your Medicare and Medicaid number. So it's the higher number.
Okay, second question that she has, student loan repayments, do they go off my gross or my net deduction before deferred comp? And that's married filing joint. The wife has the deferred comp. I only have the IRA.
Well, you mean the interest that she
Well,
pays?
student loan repayment, do they go off of my gross or my net deductions? Well, if this
It doesn't have anything to do with it.
Maybe they mean a reduced payment on their student loans.
right.
Yeah.
So that would be
Maybe they should clarify, because if you're looking at deducting the $2,500, that's just based upon your adjusted gross income.
Right.
But if you're looking for what the loan repayment figure would be, they have very liberal repayment schedules now, and you can talk to a strategies person over at the student loan repayment department, and they'll help you to figure it out so that it's as easy as possible. But obviously, you want to pay it off,
Yeah.
right?
Yeah. And the third question is fire insurance proceeds on an apartment rental. Is that tax free, or do I have to take any kind of deduction on anything? Also, we have about 6 months of lost rent beyond what the insurance company paid for.
Okay, lost rents are not deductible.
Correct.
And if you had an involuntary conversion, which a fire is, then you have to determine whether you got more reimbursement than the basis in the building. And so it could be taxable, but in most cases it's not. And you have, I believe, 2 years to reinvest that money into another piece of property if you're going to be using the involuntary conversion. But something you might want to give us a jingle on that on Monday so we can help you through this,
Yeah,
because
involuntary
it's not easy
conversion
on
is
a rental,
not
especially.
an easy topic.
Right.
That's not. They said, that's right, I'm looking to reduce my student loan monthly payment, and I'm assuming that the more I put into the retirement, the smaller the payment will be.
But they're pretty liberal in the repayment department. So
They really are.
if
They
you-
almost don't even ask you to prove it.
Yeah.
My daughter called, and they're very flexible.
But yeah, don't take that's like taking the Uber passenger's word for it. Call the student
right.
loan.
Call the student loan department.
That's sort of not our
Absolutely.
specialty. But the
Okay,
rental
but
income we are.
remember, so all of these deductions that we're talking about get added together, and if they exceed the standard deduction, then you itemize. And the same thing on the state of New York. If they exceed your standard deduction, then you itemize. Now, in the state of New York, they also allow you to take mileage if, as an employee, for instance, if you do outside sales, which is not deductible on the federal anymore as an adjustment to income if you're on a W-2, but on the state of New York it is. So you take a look at that. If you come up with an extra $10,000 at 6%, that's $600 you saved.
Yeah.
Right?
Yeah, that's
It's,
right.
You know, and we all need every dollar to pay for the Thanksgiving dinner. Right?
I keep seeing on Facebook a picture of a grocery cart, and people are like, this is the most expensive ride you can deal with, is going to the grocery store. It's very expensive.
It really is.
Yeah.
Okay, other things to look forward to is, I know electric vehicles are not very popular in Western New York, but we still got to tell you, you can get a credit up to $7,500 in the federal and $2,000 on New York State on EV vehicles. And if you buy a used electric vehicle, and believe me, there's all kinds of law that I'm not talking about because I'm trying to get through this list. But if you get a used electric vehicle, you can get a credit of $4,000.
And then don't forget that you could also push off the credit or the use of the credit to the dealer too, if that would benefit everybody.
To help reduce the cost of
Right,
the car.
because here's the thing. The EV credits and the energy credits that I'm going to talk about here in a minute are not refundable credits. So if you don't have the liability to to take advantage of these credits, then you're not going to benefit at all. So you want to make sure that if you can give that credit to the dealer, who will then give it to you as a down payment, which they can do, then it's a win-win situation. And again, before you do anything, just give us a call. We'll help you.
Yep.
Right?
It doesn't cost anything to call, and very wise. There was somebody I was talking to the other day, and he's like, my friend said I could call you guys because I have a question. And he's like, you're always so helpful. And he doesn't even have to file. He's the one that was called about the RMD, but just give us our jingle.
Right. The other thing that you should take a look at, it's getting, I mean, they're talking about a blizzard, right? And so now's the time to do energy efficient home improvements. Big change in that 30% of all these Energy Stars, new doors, windows, furnace, hot water tank, things to keep the cold air out in the winter, and the heat that's it. The heat out in the summer and the cold air out in the winter. These new credits can be up to $1,200. Again, not refundable. So you want to make sure that you have enough income to use them. And you can also get another credit for like biomass stoves and things of that nature, which could be another $2,000. So you could save $3,200 by insulating your home and making it airtight.
Yep, just got to make sure it gets done before the end of the year.
End of the year, right. But it'll slop over to next year. But I
Right.
mean, if you're looking at something contemporaneous, you want to do it now. I'm Esther Gilius, the tax lady from EG Tax, 8030930, 8030930, star 930 on a cell phone. Our text line is 716-8030930. We're going to take a short break for the news, and we'll be back on the other side with your comments, questions, and text.
The bills make me wanna shout, kick your heels up and shout, throw your hands up and shout, throw your head back and shout. Come on.
I'm going to
now,
tell you,
bills
the
make
way they've been playing, I do throw my hands up and down, right? Oh, Lord God, please help the bills. Anyway, I'm Esther Gilius, the tax lady from EG Tax, 8030930, 8030930, star 930 on the cell phone, 716-8030930 is our text number. And so why don't we go to Kathy first? Hey, Kath.
Hi, thank you for taking my call. I have a question about gambling winnings.
Yeah.
Is the only way you can offset the loss is by itemizing your deductions?
That's it.
Because it just doesn't seem fair. Like if you're
It is absolutely not fair. Absolutely not fair. And it's been this way since the beginning of time. And it's especially egregious to seniors because it makes their Social Security more taxable. But that's the only way to do it.
And you can only write off your losses as an itemized deduction up to your
Up
winnings.
to your income, right.
Yes, and over the past few years, most people are not able, and myself included, not able to itemize.
Right. Well,
But I mean,
so
you-
let's
like you could
say
have
that let's say you won
$25,
10.
like-
Let's say you're a single person and your standard deduction is like $18,000, and you won $20,000 at the casino and lost it all. Well, so you could itemize. See,
You could itemize because of the loss.
because of the loss,
the
right?
large.
But you're not going to get the full benefit because you would have gotten 18. So if you end up with itemized deductions of 25, you knock $7,000 off your taxable income, which may only save you $700. But $700 is $700. The worst thing is if you won 20,000, it would make your Social Security more taxable,
Right.
which is just
Okay, but you can claim the full loss on your
up to
itemized
the income.
deductions, though
If you
it's-
won 20 and you lost 20, you can take the if you won 20 and you lost 40, you can only take 20 as an itemized deduction.
Yes,
Okay.
Yes. Okay. Yes. Thank you very much.
Okay, sweetie. Happy Thanksgiving.
And I want to, me, like throwing in those monkey wrenches. What about those heavy gamblers who won like 100,000 at a casino or more? What does New York State do to your losses?
They limit them.
They limit it. They start backing them away. So then you end up, even though you could have lost more than you won, you end up paying New York State tax on
Well,
your
and How about I have a guy that's a big gambler, and his income is so high from gambling on page 1, even though he loses it when we itemize, he loses all his child tax credits,
Yeah.
and he's got like 3 kids. So that's $6,000 gets him right in the neck,
Yep. Yep.
right? Okay, we have a text. You wanna
The
read that?
text says, "Hello, nice people. Thank you. I received Social Security disability recently, and it included back pay from last year. Is any of that taxable? Thanks in advance."
All right, so it may be taxable, but you can do what's called a lump sum election. And you take that money that's attributable to the base years, and you basically recompute the liability that would have been had you had that money included in those base years. And if you had very little income waiting for disability, it could save you a lot of money. So it's called an LSE,
Yes.
right?
Definitely. Yep. You are correct.
And again, if you want help with that, give us a call. We'll figure out how much, because we'll know based upon your award letter how much was attributable to each year.
Yeah.
And we'll let you know what the LSE will save you.
And if there was
It can
any,
save you a lot of money,
yeah,
a lot of money.
And if there was any workman's comp, it would have all been taken care of in the payout.
Right.
Yeah.
The offset.
Yeah.
Okay, we have Dave. Hey, Dave, how can we help you?
Hello, long-time listener. With all the talk of the standard deductions, I wondered for both the federal and the state what the standard deduction was for a single individual.
Chris, you got that? Chris is going to get it. It's are
For
you over
what year?
65?
69.
Okay, you're over 65.
For what year do you want the standard
For
deduction?
2023.
2023.
Okay, just wanted to make sure. So you got $13,850 plus the extra amount for being over 65, which is it's not on here.
1,500.
It's like 1,500. So you're
Right.
you're really looking over $15,000, about 15,350.
15,350. That's
Yep.
federal.
Yep.
Right.
Do you have the same for state?
The state is lower than the federal.
It's about $8,000 for the state. They don't
the
give
state.
you anything extra for being older.
Okay, but is it too early for an exact number?
No, I can get
No,
you.
the federal, it was exact.
Okay, no, I knew that was.
Well, I'll tell you what you do. Just call us on Monday because we haven't looked at the state standard deduction. I don't think it's increased much.
$8,000.
Yeah, it's still
There you
$8,000.
You guys are good. I appreciate it.
And so are
all right.
you.
Enjoy
you for calling.
Thanksgiving.
Yes, happy
You
Thanksgiving,
too.
Dave.
Thanks, Dave.
Okay, and then we have a text. Do overhead garage doors qualify for energy credits? It all depends, right?
Yep.
It depends on if your garage is attached to your house.
And whether these are Energy Star doors.
Yep.
Right?
Yep.
But they
So
should.
so that would be a 30% credit up to $650.
So that would definitely help.
Right. That will help.
It's on the
Okay, and then
federal.
what else we have?
We got Joe from Buffalo.
Hey Joe, how can we help you? Hello?
You could put Joe on hold and go to
Joe?
Poncho.
Yep, we'll put Joe back on hold. Go to Poncho.
Hey Pancho.
Hello. That's
Hey
really-
Cisco.
Hey, nice talking to you, darling.
Nice to talk to you too.
Hey, I'm up here from down south, and I'm checking on my dad, and I did not realize his accumulated wealth over the years. He's a Vietnam vet, and he made some good investments. He owned his own home, and he plans. He's got a will made and all, but I think it would be better off with his assets, with the home and his investments, and all. Be better tax purposes wise. Would it be better for him to put it into an estate?
Well, it is an estate if, all right, first of all, upon his death, anything that hasn't gone to the, through the will to the heirs is going to go into his estate, okay? But estate taxes are much higher than personal income taxes. So you're not going to want to get into an estate taxability situation if at all possible.
And he's going to want to make sure he has beneficiaries on all of his.
Right. You want to make sure your dad has everything with the beneficiaries so that you inherit it, so that it goes to you and not his estate.
Well, actually, I don't want anything to do with it. I'm going to let my cousin be the executor.
Well, whoever.
Yeah.
But
I mean, you may want the house to go in what's called a life estate right now, which will protect the house from a nursing home.
Is he well now?
Yeah, actually, he's doing just too much well. He's 83. Sometimes they can be difficult. Yeah, but he's all right. Yeah, he's been doing all right. He's doing his meds and all. But I just wanted to avoid any estate taxes down the road.
Well, he's not going to pay. All right. There's estate taxes if your estate exceeds $13,750,000. Okay, so Dad doesn't have to worry about that. But there is a decedent's estate return for income earned upon their death that didn't get transferred over to beneficiaries, which has a very high tax rate if the assets go into there. So that's not a good thing to do.
And to
so why don't
avoid
you
that-
Pancho, why don't you have Cisco call us and we'll help him to make sure that he doesn't get that will help with Dad's estate so that it flows through as best as possible. There's no charge.
Very well. I'll advise him of that. He's in the backyard right now. But I've tried to get him over here to listen to this, but he walked away.
That's okay. Well, we
Wanted
will
him
help.
to hear this. So
we will help. And you can bring Dad and we'll just sit down together.
Very well, Ben.
All
Thank
right.
you very
Thank
much.
you. Happy Thanksgiving.
You too.
Okay,
Thank
and do we have Joe back?
We do.
Hey, Joe.
Hey, hello.
Hi.
You hear me? Oh,
I
okay,
can.
good. Yeah. I actually have a question. I've been helping my grandson a lot. He graduated from college, and he qualified for the loan forgiveness, so he has, for his federal loans, he has zero pay right now. But we were discussing this, if he gets money on. I quite don't understand is if you can make payments, even though it's zero. What is your payment schedule? Because they say, it'll go against the interest. I'm a bit confused about the interest earnings and being able to pay when you don't have to.
All right, so are you saying that they aren't requiring him to make payments, but he does have a balance?
Yes. Yeah, he's got it.
All right, so
out
so even though he's not required to pay, you want to still pay because the debt is still hanging out there, and so.
Unless he works for a, does he work for a non-for-profit agency?
No, he doesn't. No, he
Okay,
doesn't.
because
so
then
you want
the 10 years.
So even though sometimes it's like giving you a loaded gun to play with. They're saying you don't need to make payments, but here the liability is accruing. So you really do want to make payments if you possibly can. But if his income's low enough and they say that he doesn't have to, then he doesn't have to make the payments, but the debt's not going away.
What's confusing is when you read this thing, they give an example of if you have a $50 payment or something, and you pay $30, even as long as you're making a payment, some of the interest doesn't accrue or something. And
because when you put the money on the note, that's reducing the principal. And so then they're not going to charge you interest on the principal to which you just made the payment.
So what you're saying is you're making a payment. It's a principal-only payment, even though you have no liability, no requirement to make the
That's exactly right.
That's what I didn't get out of the whole thing. I was trying to.
So that's why you really want to get the thing paid down.
Right.
I mean, it's not getting any smaller. They're not making you make the payment, but in the end, it's going to bite him in the butt.
And then still, if he worked for a non-for-profit agency for 10 years, go on. What were you going to say, Chris?
You might want to look at, because each year there's a different loan that he was in school. And you may want to look at his loans to see which ones have the higher interest rate and pick those ones out that the principal's getting applied to now.
That's a very good point, Chris.
Right. Well, what he did, fortunately, he was a good saver kid, really. But when he applied and then we got the clearance to do it, he had two loans at 5% that for about $7,000. He was able to pay them off. He saved for that.
Well, that's great.
So that, he's helping that part of it. But you're right. Going further, then we were talking about how to do it. And I was just trying to understand that savings. And
so anytime you have an obligation and you make a payment, that payment goes to principal and interest. The interest would not reduce the debt, but the principal payment will, and so therefore the interest won't be charged on that. So if you can pay it off, it is in his best interest.
So, but what you're saying, it's in effect, it acts the same way as a normal mortgage, no matter what you do.
Absolutely. Absolutely.
Okay. So you're still paying on interest and principal as long as you pay something.
Right, unless some miracle happens and they get rid of the student loan debt.
Well, at least it's helping that he doesn't have to pay all of it right away.
Yeah, that's true.
Yep.
Okay, thanks for calling, Joe.
Thank you very much.
All right, happy Thanksgiving. I'm Esther Gullius, the tax lady from EG Tax, 8030930, 8030930, star 930 on the cell phone. Text us at 716-8030930. And after the break, I'm going to talk about gifting, and it'll kind of tie into what Joe was talking about. Talk to you on the other side. Hey, to us, you are family. I'm Esther Gullius, the tax lady, joined in studio with Christopher Fabian, Tiffany Fabian, and we just want to help you and want to make sure that you don't overpay your taxes. So talking about Joe's situation where he's talking about his was it his grandson or his son?
Grandson.
His grandson. So you can, a lot of times people say, how much can I give before I have to file a gift tax return? Well, right now through December 31st, you can give up to $17,000 per person per year. Starting next year, it goes to 18. But over and above that, if somebody like Joe wanted to have paid for his grandson's college, that's over and above the 17,000. Or if you paid for somebody that your relative that was sick, the medical over the 17,000 doesn't go against having to file a gift tax return. So a lot of people are interested how much they can give and not have to file a gift tax return. But here's the thing, even if you gave somebody $40,000, is that really going to cost them money?
No.
In most situations?
No. It's just a preliminary bookkeeping form that you have to do.
Right. So you have to do a tax return, a gift tax return that says, wait, I gave more than $17,000 to this person, and it adjusts your unified exclusion upon your death when you finally have to pay Uncle Sam, because they've been waiting for that money too. But right now the estate exclusion is approaching $14 million. So you'd really have to have some hefty numbers before you'd have to ever file and pay gift taxes.
Correct.
Exactly.
Right?
Yeah.
Yep.
Okay, another thing, again, 8030930, 8030930, star 930 on a cell phone, 716-8030930 if you want to text us. RMDs, you don't have to take your required minimum distribution until you're 73. And in the year that you turn 73, you can actually hang over to the next year up till April the 1st and take that first required minimum distribution, right?
That's right. But you might not want to, but you absolutely can.
Yeah. Well, I mean, if the required minimum distribution, you do. But then you would double dip that year. And if you wanted to do the qualified charitable deduction out of your IRA, you can roll over from your broker or your financial planner to your charity up to $100,000, and so you won't have to pay taxes on the distribution.
Right. Doesn't touch your hand. They write a check. It goes right to the charity.
Right.
And it reduces your income on page one on the tax return. So it doesn't even show up as charity. It reduces your income.
Right.
So that's a win-win.
It is. It's a great thing if you're philanthropic. Max out your 401k plan. If you're under 50, you can put up to $22,500 away, $30,000 if you're 50 or older, and it's an elective deferral, so you still have a month and a half to load that thing up so that you don't have to pay taxes. Think about converting to a Roth, from converting a Roth to a traditional. from a traditional to a Roth, but be careful because you pay taxes up front. So like we were talking about, if you have that big standard deduction and you're not paying taxes, move some money from your traditional to your Roth.
Right.
Right, but don't move too much or else you could pay taxes. So you want to make sure that you know how much to move. And if you do it systematically over 8, 9, 10 years, you could unload a whole bunch of money and you got the tax break and you didn't have to pay taxes at the end.
Yeah.
Which is pretty cool, right?
That's right.
Sell losing stocks, and if you love the stocks but they're just not performing, you can buy them back in 31 days and you're able to take the loss against all your other qualified dividends and capital gains plus $3,000. Right?
Yep.
New to Social Security payments, fill out a W-4V. People don't realize that your Social Security might be taxed. And so if half of your Social Security added to your other forms of income exceed how much? $32,000 if you're filing a joint return, $25,000 if you're single. That's been the same for years and years and years. And so you might have to pay taxes on your Social Security. So, but you can fill out the form W-4V with the Social Security Administration, and they'll start withholding taxes on your Social Security so that you're not shocked when it's tax time.
Yeah,
Yep.
and it's only potentially taxable on the federal, not at all to the state. New York State is kind to retirees. Oh, there's a caller. I was shirking on my responsibility. Sorry. Marlene.
Okay, and then there's a Medicare surtax on earned income over $250,000 married joint, $200,000 single. There's the marriage penalty. Two singles are $400,000, married joint $250 of 0.9% on the excess. So that's something else to look at. And if you are looking to do the catch-up provision and you make more than $150,000, that money has to go into a Roth. It can't go into a traditional 401k.
That's a new change.
Right?
Yeah.
Okay, we got Marlene. Hey, Marlene.
Hi. You always talk about the $13 million or something that's not taxable.
Right.
You know, when you die. How much is it on the state? What is the maximum?
Do you know off the
I'm
top
gonna
of your head?
Google
it's
it real
around $1
fast.
million.
It's like 5.6 million.
Yeah.
But I will.
Wait, Chris is going to let you know. Are you someone with high assets?
Oh no, I just wondered if it was something stupid like 100 million or 100.
Oh no, on the state of New York, it's much lower. Not all states make you pay an inheritance tax, but New York State is one of
And
them.
actually, it's 6.58 million.
Okay.
But if
you know, a lot of people might think it's 13 million because same as the federal, right?
Right.
Yeah.
No, you pay at a lower threshold in New York State.
Uh-huh.
Good
Okay,
question,
thank you very
Marlene.
much.
And
Thank you, dear.
I just saw an article that the owner of Amazon, what's his name?
Bezos.
Jeff Bezos just moved out of New York as his primary resident, and he might be somebody who
Oh, they're going to watch him
Right.
like a
yeah,
hawk.
that would factor into that limitation. So
Right. So you pay money that as you earn it, and then upon your death, they tax you again.
yeah.
Okay, in businesses, if you have a business that did well this year and you're looking at cutting your tax liability, one way to do that is to buy assets that you need, such as a vehicle, machinery or equipment, things of that nature, that you can take and write off 80% this year of the new or used equipment. But this is a decreasing deduction. Next year it'll be 60%, then 40, then 20. So the special depreciation allowance is starting to phase out. And if you have heavyweight SUVs, and that's a vehicle that weighs more than 6,000 pounds, then you can expense up to $28,900 of that expense for your business, and that will save you a lot of money as well. Right?
Yep.
Yep.
And don't forget that you have pass-through deductions on profits up to 20%. So if you've been doing it yourself and you never took that pass-through deduction, amend the returns because there's a 20% pass-through of the net profit. on your business, and it could even include rentals if the rentals were handled like in a business-like manner, right?
Yep.
Right.
And then don't forget about the 1099-K forms coming through the mail. Very important. If you're getting third-party payments, they're going to send you that 1099-K form. Keep track of your expenses now. And if you have been doing it to make money, you want to make sure that you keep track of the expenses. And if you need new equipment or something, get it now so it'll reduce your overall liability and FICA.
Yep.
Right?
Okay, you want to go to Monty?
Monty. Hey, Monty, how can we help you?
Hi, thanks for taking my call. I had an issue with my workman's comp audit. They were getting backed up. They were going to reassess me. I didn't know what I should do because they wanted me to upload it, and I'm not a computer guy. I work with my hands, and if you saw my hands, it proves I work with my hands. And one of the smartest women that I know, Esther, next to you and your daughter, is Maria. Your Maria.
She is
she
good.
saved the day for me, and I'm glad you guys got her, and I hope you always do because I might follow her. But she every time I've ever needed something, she's always helped me with it.
She is
And
remarkable.
it's nice to know
I've never
somebody-
seen anybody with a work ethic like Maria.
She does the work
and,
of
you
three
know,
people.
also
She really
Maria-
does. She has and she's smart. And I don't know what we'd do without her. And thank you for those kind words, Monty. We agree.
Also, Esther, like you and your daughter, she's not bad to look at. Have a great day. Thank you.
That's great.
Bye.
All right. That must be one of the things he's thankful
As
for.
soon as I'm off the phone, I'm going to give her a buzz, Monty. I think you will make her day.
Yeah, that's true.
I will
That's
call
true.
her. Thank you.
All right.
There's
I'm
a
Esther
text.
Golias,
There's a
text.
text. There's a text. Qualified charity distributions is a great way to contribute to your church instead of putting cash in the collection envelope.
That's exactly right. So if you kind of save up, because that's the way I do it with my giving. I don't give weekly. I just give a lump. So I do the
It's
QCD.
not a lump of coal.
I get a lump of money. I do the QCD rollover, and it doesn't cost me anything. And that's the whole thing. If you heard something that tweaks your curiosity, give EG Tax a call. We're not going to charge you. We'd love to help you, and we think of you as family. So,
Right. And I just want to say we do have our Toys for Tots
I was thinking about that.
bin in our waiting room
Meant
at our
to
corporate
do
office.
that.
If anybody wants to drop off an unused new toy,
and Chris won't play with it.
and I won't play
I
with
love
it.
you,
All right.
Dan.
All right. So everybody have a wonderful Thanksgiving. Make sure you think about what you're blessed with, because hopefully our country is going to weather whatever's going on with it, and we pray for Israel. So until next week, I'm Esther Golias, the tax lady, with Christopher Fabian, Tiffany Fabian. I'm Esther Golias. If you need us, go to egtax.com. Call us 632-7886. Thanks for listening. Have a great week.